Let's just talk about markets now. And joining us right now is Anup Maheshwari. He's Vice President, Head Equities and Corporate Strategy at DSP BlackRock. Anup, thanks very much for your time. Good to have you with us here. Before we get into talking about what 2016 might hold for markets, can you tell us, in your mind, what are the 2 or 3 most important takeaways from 2015, which naturally will have lasting implications into 2016 as well?
Well, from a market standpoint, I think what's most important is corporate earnings. And I think 2015, in that sense, the big letdown was on the trend of corporate earnings. I think a lot of us were hoping for some sort of pickup coming through. But that's been the trend for the last 7 years now. It's quite rare that we've had actually 4 consecutive quarters of degrowth up to the last quarter of September, year-on-year degrowth, which is definitely not something that was anticipated. I guess the good news is that now that we have a fairly low base, December quarter and March quarter as we head into the new year, will actually show some degree of growth in the region of between 10 and 15%. So at least we seem to be through the phase of degrowth as far as earnings is concerned. The key, of course, remains when earnings pick up in full earnest, and when do we get back to that sort of 15% plus type of earnings growth range, which I'm sure most analysts will assume will come through for FY17. But as we've seen from the past, we literally have to take it quarter by quarter to see whether those numbers are actually coming through. So it's really, to summarize, the key feature of 2015 was the lack of earnings, and we're hoping the key feature in 2016 will be, some accretion to earnings that will come through.
One can be disappointed just looking at 2015 in isolation, but if you look at the market performance this year and the backdrop of corporate earnings, then I guess one should be pretty okay, pretty all right with the market performance, right? Market's done quite okay in that light.
Yeah, so it's done okay in pockets. So what's really interesting about this market is the fact that there is a lot of liquidity on the one hand, and in a fairly low growth world, and in a scenario where you've had commodity prices and just a lot of asset values compressing, there have been pockets of growth as well in the market in corporates. So what's happening is there's a lot of liquidity that is very sensitive and is finding its way into whatever growth pockets are available, whether it's a large cap or a mid cap. And you've obviously seen it a little more in the mid cap space. And therefore the mood of the market has still been to go in and re-rate stocks which are demonstrating growth. So the growth pockets are getting rewarded, even disproportionately rewarded to some extent. There's been other parts of the market that have just not performed at all. So at an overall level, you're right. I mean, the market performance, as you go down at a stock level, if you actually equally weighted the 1,000 stocks in the NSE, you would have actually produced a 30% return. It's as odd as that, with the Nifty actually creating a negative return for last year. So it is a sort of, it's quite ironical actually that as you go down the chain, you've seen some performance, but at a index level, it's clearly not seemingly coming through yet.
In terms of flows, if we kind of look back, this is also the first year after 2009 that I think FIIs have been sellers.
Yeah, so they were buyers at the initial phase, and we've ended the year with them being more on the sell side. Not entirely surprising, frankly, because the whole mood towards emerging markets changed during the course of the year. Global funds anyway have not been very active in India, and added to that, with the whole oil price compression, we hear of sovereign wealth funds also actually taking money out instead of putting money into a lot of markets. So from a foreign portfolio investment perspective, it has been sort of the last few months have been a bit shaky. But clearly, as we've seen this year, it's been more than compensated by domestic flows that have been very, very sharp. So, that's been the good side, I guess, to the markets.
And I guess, in terms of the local flows, most project this $1 billion a month inflow into equity schemes to continue into 2016 as well. Is that a fair assumption to make? Because, it's only been recently that market performance has started to disappoint. I mean, if this stretch continues, then in that light, is it fair to expect these strong inflows, local flows, to continue?
Yeah, there's a bit of a circular effect to that because, money tends to come as markets are doing well. So, money in some ways chases momentum. And when markets don't perform well, then the money, as we have all experienced, tends to also go slow in terms of, incremental investment. So I think there's a bit of a circular effect. I think people are a bit disappointed with the one-year returns that have come through from the market. It's definitely not what people expected a year ago. To that extent, you may see some degree of, absolute flow movement being lower than what we were getting at the start of the year. But it's all a function of momentum. If earnings do come through, markets start performing, then I think money will come through anyway.
On the FII side, any way to call that one at all?
That's trickier. Frankly, we have fairly low expectations in terms of FII flow because we're not very clear where it's going to come from. So the FII one is probably a little more difficult to call. FDI flow looks pretty good and robust, and we've seen that last year as well. But for portfolio inflow into the market, it's still looking a bit challenging. I can't say we're hugely optimistic on it. I think we're more counting on domestic flow over foreign flow.
Which you already kind of just said that is going to be lower on an absolute level, right? From what we've gotten used to. That's about $1 billion coming into equity schemes every month.
Yeah, it depends, as I said, a bit on the momentum. If the markets start moving back up, if earnings come through, then it could be a bigger number than last year eventually. Because there is a lot of liquidity out there, ownership, there's a lot of under ownership in equities. We know that whole story. I mean, the other options are not necessarily available. So you just need one asset class to do well for people to end up, allocating more to it. And therefore, as I said, it's very sensitive to the momentum and to the performance of the market itself.
How much of the FII interest do you think is in India is predicated on the relative attractiveness of the Indian market vis-a-vis others, as compared to absolute love for the market in terms of earnings growth and that story? How much of it is relative, how much of it is absolute from an FII sense, you think, Anup?
Well, Prashant, life is relative. So, as an international investor, a lot of your choices are driven by what else is happening elsewhere in the world. To that extent, India, from a macro standpoint, I think it's still very universally accepted that India is in a much better position than most other places in the world. The key challenge, though, is it has to transmit itself into corporate earnings in a more sustainable fashion. The two variables that we tend to focus on in any market is interest rates in that market and the ROE of corporates listed in that market. And that spread is very important. That spread effectively is the value that corporates are adding in the system, and that's why you get the market cap or the stock market value that you get. Now, India, interestingly, is sitting at a position where we're at our lowest spread of the last decade between ROE and interest rates. And if anything, if there's any catalyst for that to improve, that should be very positive for markets. Contrast that with some of the developed markets which are sitting at the other extreme end, where interest rates have been very low and ROEs have managed to hold out. So there we're sitting at all-time high spreads. So there are discrepancies in the world right now, especially between developed markets and emerging markets. And currently the consensus view is still more towards developed markets over emerging markets. And it's interesting because we've seen consensus views invariably not working in this type of a world at the moment. So I guess the coming year will be interesting to see in terms of, as interest rates start rising globally, what implications that will have for developed markets, and whether at some point emerging markets start looking interesting again, given how much they've contracted in value. So life is relative, and I think within emerging markets, India is still, probably one of the better ones to invest into.
So, are you suggesting, as some have, that even though rates in the developed world start to go up, it's already happened in the US, despite that, because of the huge underperformance for dollar investors that emerging markets have been over the last many years, emerging markets might themselves be at a turning point for the better?
Yeah, it's a difficult call to make, Prashant, because it's all a function of how other markets evolve as well. We've seen again big divergences in emerging markets linked to commodity price movements. So you've had serious macro issues in some other emerging markets, and that's reflected in their stock prices as well. Here we've actually got the benefit of a lot of that. So I would have to say, from a macro standpoint and from a balance sheet standpoint, India is probably better positioned than most places. It's how we utilize it, how that transmits into corporate earnings. Again, in a fairly low growth world, wherever there are corporate earnings, money will tend to gravitate towards those markets. So for us, this is a very critical year, in terms of whether corporate earnings do pick up in full earnest or not, in more ways than one. That will determine our relative performance to other emerging markets as well.
Do you see enough triggers for corporate earnings growth in India in 2016? And where from exactly, Anup?
Well, we've, one trigger, of course, it starts typically with slightly lower interest rates in the system, which we've already seen at the short end rates coming off, although it's a bit sticky at the long end yet. But ideally, a lower interest rate should start seeping into a bit of corporate earnings improvement. The other factor, of course, is margin improvements that come through because of lower commodity prices, which we started seeing from the last quarter. But finally, what you really need is a pickup in sales growth, and that's been actually very lackluster. So if you get that combination of a pickup in sales revenue growth and your margins are anyway improving because of lower commodity prices and interest costs, then you get a fairly strong catalyst for profit growth. So the top line is really a key focus area, and that's a function of how much the government starts spending in the system, how corporate confidence starts building up, and how consumption picks up. The festive season has been quite good, so that's a heartening sign. But again, what we have to see is things sustaining over a period. We've had too many of these small improvements which have not carried through. So we need to just see a couple of quarters where this continues for a while, and I think that will give us a lot more confidence on the corporate earnings pickup.
Do you believe that, you personally believe that we will get onto the sustainable track sometime in 2016?
Yeah, so we're definitely hopeful of that. I think we're counting on. So, for instance, commodity stocks within the index have actually compressed dramatically in terms of profits. So we're actually sitting at a very low base that will support some degree of growth next year. So the cyclical effect of earnings should hopefully be better next year. The more consistent companies are continuing to perform anyway within a certain band. So we are hopeful that we do definitely move up the trajectory in terms of corporate earnings growth. But things have been coming in the way for the last 7-8 years, which were unpredictable. So we have to keep an eye out for that as well. But overall, our assessment also is that earnings growth will start picking up from next year onwards. As I said, we don't have all the evidence to back that up now, and it will keep coming through over quarters. But the government spending program has to be a fairly strong catalyst for the overall movement of liquidity in the system and a general uptick across business to come through. So that is one of the key variables that we'll have to keep an eye on to get that confidence of higher earnings.
One of the factors actually, Anup, which you said will be important. An important catalyst is government spending. So I'm going to ask you, are you happy with the quantum of government spending, essentially the amount of money which they're spending and where they're spending on?
Yeah, so directionally, everything that's happening seems to be in the right place. I guess it's more just the pace of it. There's still a lot of little blocks in the system that are not allowing necessarily a full-fledged spending program to come through. And we've seen some improvement in certain pockets, but it's not as widespread as we'd have liked it to have been by now. But we're hopeful again at some point it will come through.
Okay, let's get to some stock sectors, etc. Which sectors, Anup, are you most bullish on?
So we like the consumer discretionary area, which is basically consumption, which will hopefully be driven by slightly lower interest rates. So that includes auto, retail, a whole bunch of smaller sectors. So consumer discretionary we continue to like. I think private sector banks still continue to look like a fairly good place, very structural, long-term, good investment ideas there still. On the energy space, we're actually a little more optimistic in terms of the positions we hold in the fund. And apart from that, it's very, very stock specific. Some of the more defensive sectors, we know that valuations are clearly on the side of, don't give you much room for error, frankly. So there it's more stock specific. I wouldn't say we're generally overweight. We're actually underweight some of the more defensive sectors like consumer and pharma, etc. But I'm sure there will be pockets of opportunity in those areas as well.
So, I mean, consumer discretionary, private financial, private banks basically, and energy, if one were to just crystallize what you said into sectors, right?
Yeah, that continues to be areas where we're definitely overweight. Yeah, these are some of the broad areas. And then it's very stock specific beyond that.
Yeah, in a way, Anup, the priority is not really on global themes, right? Companies which derive the primary source of earnings growth is, the global market. Is that a differentiation that you're making? Because many do.
No, it's very stock specific. I mean, there's some companies which have global markets that are doing quite well. So, to that extent, the pharma sector still continues to do reasonably well on its exports. Textiles are doing very well on exports. Chemicals are doing very well on exports. But other sectors are suffering. So it's a bit of a mix. It's not that if you have a global market, you're automatically not doing well. I think it's a very bottom-up market in that sense, Prashant, which is why I'm saying, there being growth pockets, you've got to literally go look out for them, and that's where you're seeing, some degree of price appreciation. But very, very stock specific.
Any interest in, actual infrastructure creators, hard infrastructure sectors, or as you said earlier, you like private banks, so play that through lenders rather than infrastructure developers themselves?
No, we have some industrial positions, but I would say they're more on the port side and more on the equipment side more than core infrastructure in terms of power or some of the other larger infrastructure areas. Roads and construction also we're quite optimistic. So we've got a few exposures there as well.
Anup, thanks very much. Great speaking with you. Appreciate you joining in.